Hello, my name is Troy Atkins, and I am the founder and owner of Atkins Capital Management. I want to talk to you today about the key housing events that have transpired in the U.S. residential housing market during the second quarter of 2020. During the second quarter of this year, the impact that the COVID-19 pandemic is having on the mortgage loan interest rate environment, the monetary policy actions of the Federal Reserve in response to the COVID-19 pandemic, and the St. Louis Federal Reserve's examination of the trend in the cost of debt for a 30-year fixed-rate mortgage loan and the 10-year Treasury yield over the last 50 years were the primary topics of discussion. This movie presentation also provides an overview of the home price level for a select group of cities that make up the Atkins 60 City Home Price Index, and it provides a wealth of information for prospective homebuyers to use in order to make a prudent home purchase decision. This presentation was written, narrated, edited, produced, and published by Troy Atkins. I am the founder and owner of Atkins Capital Management. Atkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. Our company is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 15 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, and more than 8 years of freelance financial writing experience. I am also the author of more than 25 published articles. For more information about my background, skills, and experience, please visit the Atkins Capital Management website. With this overview in mind, let me now turn your attention to the primary housing topics for the second quarter of 2020. During the second quarter of this year, the historically low mortgage loan interest rate environment was the primary topic of discussion. The month of June experienced the best month in the history of the mortgage market, with the national average mortgage loan interest rate for a 30-year fixed-rate loan dropping below 3%. The historically low interest rate environment was driven primarily by the impact of the COVID-19 pandemic. Going forward, it is logical to conclude that if the COVID-19 pandemic continues to curtail the U.S. economy, mortgage loan interest rates will continue to remain low or even inch toward more all-time lows. In response to the impact of the COVID-19 pandemic, the actions of the Federal Reserve also helped drive mortgage loan interest rates to historically low levels. The Fed helped restore liquidity in the capital markets by directly buying mortgage-backed bonds. In accordance with these events, the national average mortgage loan interest rate for a 30-year, fully amortized fixed-rate loan reached a new all-time low of 2.95% by the end of the second quarter. The previous all-time low of 3.31% was reached in November of 2012, and the all-time high of 18.63% was reached in October of 1981. Over the second quarter of 2020, the national average mortgage loan interest rate for a 30-year, fully amortized fixed-rate loan fell by more than 0.75 of a percentage point. In view of the economic impact of the global COVID-19 pandemic, the Federal Reserve maintained the target range for the federal funds rate at 0% and 0.25%. A recent analysis conducted by the St. Louis Federal Reserve also illustrates an important point for prospective homebuyers to understand. The following chart illustrates the gradual decrease in the cost of debt for a 30-year fixed-rate mortgage loan. The landing rate for the current mortgage loan interest rate environment is remarkably low. According to the St. Louis Federal Reserve, during the past half century, mortgage loan interest rates and the 10-year Treasury yield maintained a relatively tight band. For most of the time since 1970, the 30-year mortgage loan interest rate has been roughly 1 to 2 percentage points higher than the 10-year Treasury yield. While the Federal Reserve is concerned about the incomplete transmission of Treasury yield declines to mortgage borrowers, because changes in mortgage rates are an important way monetary policy affects the economy, qualified prospective homebuyers should be very satisfied with the current lending environment. Now that I have provided an overview of the events and trends that have taken place in the residential housing environment for the quarter, let me turn your attention to the proprietary finance-based analytical methodology and cloud-based residential real estate analysis software application that you can use in order to provide an assessment of the price level of homes in your community. The Atkins Residential Home Valuation Analyzer is an internet-based software application that analyzes the relationship between the median home price level for a city and the median household income level for the city. With this information, the software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the Atkins Residential Home Valuation Analyzer can accurately assess the price level of homes in your city. From the first analytical perspective, the Atkins Residential Home Valuation Analyzer determines the level of underpricing or overpricing of homes in your city by calculating the mortgage loan interest rate that justifies the price level of homes in your city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately assess the level of underpricing or overpricing of homes in your city. From the second analytical perspective, the Atkins Residential Home Valuation Analyzer calculates the percentage of household income that would have to be spent by the people that live in your city in order to justify the price level of homes in your city. With this information, the justified percentage of household income amount is compared against the traditionally accepted household income amount of 28% in order to accurately assess the level of underpricing or overpricing of homes in your city. By utilizing the Atkins Residential Home Valuation Analyzer, you can determine the level of underpricing or overpricing of homes in your community, as well as the magnitude of underpricing or overpricing of a specific home that you are considering to purchase. This in turn will help you make a prudent home purchase decision. For more information about our finance-based analytical methodology and the use of the Atkins Residential Home Valuation Analyzer, please review our finance-based analytical methodology report on the Atkins Capital Management website and watch the wealth of movie presentations that provide an overview of the Atkins Residential Home Valuation Analyzer. Moving away from the impact of the COVID-19 pandemic and the monetary policy actions of the Federal Reserve on the U.S. mortgage environment, and instead focusing on an assessment of the price level of homes across the country, it is important to note that for the second quarter of this year, 20 cities that make up the Atkins 60 City Home Price Index were classified as overpriced for the quarter. San Francisco, Los Angeles, Honolulu, New York City, and Boston were identified as the 5 most overpriced cities in the index. In terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities by reducing the 30-year fixed-rate mortgage loan interest rate from 2.95% to 0%. Therefore, in order to classify the homes in the top 5 overpriced cities as underpriced, it would need to be deemed prudent by prospective homebuyers to spend more than the respective justified percentage of household income amount. In order to justify the median home price level for each city, The median required household income level would need to increase to a level within the respective range of $113,911 and $246,613. Based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities fell within the respective range of $321,845 and $536,194. Prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the level of overpricing of homes in their community. On the other side of the spectrum, based upon the justified percentage of household income amount, 40 cities that make up the Atkins 60 City Home Price Index were classified as underpriced for the quarter. Detroit, Jackson, Baltimore, St. Louis, and Indianapolis were classified as the top 5 most underpriced cities in the index. While Indianapolis, Cleveland, Memphis, and Pittsburgh had the same justified percentage of household income amount, Indianapolis had a slightly higher justified mortgage loan interest rate amount. Detroit and Jackson were classified as the most underpriced cities in the index, based upon both their higher justified mortgage loan interest rate amounts and their justified percentage of household income amounts. In order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 2.95% to more than a justified mortgage loan interest rate amount for each city, or it would have to be deemed imprudent by prospective homebuyers to spend as much as the respective justified percentage of household income amount for each city in order to repay the cost of a mortgage loan. Given the recent events that have transpired in the residential housing market, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to analyze residential real estate from 5 financial perspectives. First, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the level of underpricing or overpricing of homes in their community. Second, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the largest amount of money they should spend in order to purchase a home. Third, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the amount of money they would need to earn on an annual basis in order to be able to afford to purchase a specific home. Fourth, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess total home ownership costs expressed as a percentage of household income. And fifth, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess how much a home would need to appreciate in value each year in order to offset the costs associated with owning the home. By assessing residential real estate in this manner, prospective homebuyers will be able to make a prudent home purchase decision. For more information about the Atkins 60 City Home Price Index, to watch our catalog of residential housing movie presentations, or to subscribe to use the Atkins Residential Home Valuation Analyzer, please visit the Atkins Capital Management website at residentialrealestateanalysis.com. This is Troy Atkins, saying thank you for taking the time to listen to this presentation.